Hello, everyone. My name is Greg Bordenero, and I'm the editor of the Hartford Business Journal. Thank you for joining us for our annual Economic Outlook Forum. This webinar will begin with brief remarks by each of our panelists, followed by a deeper panel discussion. We'll take a look at the short and long-term economic outlook for the region and state, and then uncover insights about what the economic indicators are saying and what the future might hold for Connecticut's economy, including broader trends and key factors that employers should know about. Our panelists today include Kenneth Entenmann, Chief Economist and Chief Investment Officer at NBT Wealth Management, Daniel O'Keefe, Commissioner of the Department of Economic and Community Development, and Johanna Bond, President of the Middlesex Chamber of Commerce. Before we kick things off, I'd like to thank NBT Bank for their support of this webinar as our presenting sponsor. Making this forum happen takes a lot of planning, and we appreciate the support we have received from NBT Bank. Here to say a few words on behalf of the bank is Connecticut Regional President Andreas Kapitanopoulos. Welcome, Andreas.
Thank you, Greg. On behalf of NBT Bank, I'm pleased to welcome you to the Hartford Business Journal Economic Outlook webinar. This year's survey results suggest a lot more optimism than we have seen in recent years. There are still challenges out there, specifically a tight labor market that does not appear to be weakening, but on the bright side, inflation has eased and continues to move in the right direction. At NBT, our experienced team members partner with our customers to find solutions to overcome these challenges. We have steadily expanded our presence in Connecticut to over 90 employees in 6 offices, including West Hartford, Glastonbury, and 4 additional locations in northwest corner of the state. With 153 locations throughout the Northeast, NBT's scale, along with our local decision-making, enables us to remain responsive to small business needs, including lending, wealth management, 401k record-keeping, and insurance. I'd like to take a moment to extend my thanks to Greg and his team for helping pull together this great program, and I look forward to hearing more from our panelists. Thank you, Greg. Back to you.
Thank you, Andreas. Now I'm going to briefly jump into the results of our annual Economic Outlook survey. During the month of November and early December, the Hartford Business Journal released a survey and asked subscribers to weigh in with their predictions for Connecticut's economy. The survey was emailed to over 12,000 HBJ Today subscribers and received nearly 300 responses. The survey found that Hartford Business Journal readers are more optimistic about 2024 than they were a year ago. In fact, 43.6% of HBJ readers say Connecticut's economy will improve significantly or slightly this year. A year ago, 36.5% of readers predicted the economy would improve in 2023. Meanwhile, 28.4% of readers expect the state's economy to decline in 2024, while 28% expect no growth. There were other notable findings in the survey. 58% of respondents said they can't find or are having difficulty finding qualified workers to fill open positions, confirming that the workforce shortage still remains a drag on the economy. 52% of respondents said they will have to raise wages in the year ahead to attract employees. And despite concerns about office space downsizing, nearly 71% of respondents said they don't plan to make changes to their office space in 2024. And 56.5% of employers said they will allow their employees to work from home this year on a part or full-time basis, down from 70% last year, which could indicate employers will be making a bigger push to get people back to the office this year. If you're interested in seeing the full results of our survey, you can go to our website at hartfordbusiness.com. For now, I want to move on with the rest of the program, giving each of our speakers 3 to 5 minutes to talk about the top issues they think will impact the local, state, and national economies in the year ahead. And I'd like to start with Ken Entenmann, the Chief Economist and Chief Investment Officer at NBT Wealth Management. Ken, welcome and thank you.
Well, thank you, Greg, and thank you to everybody at the Business Journal for inviting me again. And so, our view of the economy is somewhat similar to what the survey suggests. We are cautiously optimistic about 2024, and boy, what a difference a year makes, as you alluded to, Greg. 43% of your survey thinks the economy will improve significantly or slightly in 2024. When we look back last year, really the whole world was expecting the economy to go into a recession. And we spent all of last year waiting for Godot to arrive, and that recession never happened. When we look forward into 2024, economic growth was very strong in the third quarter. It tapered a little bit in the fourth, and we would look to have the year-end data for GDP in the United States to come in somewhere in the neighborhood of 2 to 2.5%. And we believe that that's going to continue on in 2024. We think the likelihood that we have a recession, given the robust consumer spending that we've experienced in the last half of last year, as well as a pretty resilient labor market, it makes the likelihood of a recession pretty small. So we're cautiously optimistic on economic growth. Also fueling that optimism is the trend in inflation. Last year, inflation was front and center. The consumer price index peaked in June of 2022 at roughly 9.2%. It is now hovering below 4%. We now have a 3 handle on inflation, and it's widely expected that that trend is going to continue. So that is good news. I think that the trend in inflation is very positive. The question is, can we go from that core inflation number hovering around, in the high 3s, 4% neighborhood? Can we get it down to the 2% target of the Fed? Many economists feel that's the case. I happen to think it's going to be a little bit more challenging to do that, but clearly the trend in inflation is working pretty well. Lastly, in the employment market, just last Friday, we had the unemployment report. Once again, pretty strong payroll numbers, unemployment rate at 3.7. We think while we do think the economy is slowing a little bit by most leading indicators, there's some slowing, including last Friday's ISM service numbers. There is some slowing, but we think it's slowing to that 2% target, and that the unemployment rate at 3.7%, there's a chance that that can tick higher, but I would say that unemployment is going to hover in that 3.7 to 4% target range for the year. So that's a pretty healthy forecast. 2% kind of trend-oriented growth with a very small probability of recession, inflation continuing to trend lower, and employment at 4% or better. That's a pretty good scenario that's been built into the markets, and certainly the very strong market activity in the financial markets. The drop of interest rates, the 10-year Treasury went from 5% to 4% in the last 3 months of the year, and obviously the stock market had a gangbuster third quarter, and the S&P 500 finished up 25%. We think that's largely reflected already in the markets, and I think there's a challenge. And the one caution I would give everybody is the expectations in the interest rate markets are for the Fed to begin cutting rates in March, and the futures market indicate that the markets think the interest rates will come down by 160 basis points. We think that's a little bit optimistic if, in fact, you get 2% growth, no recession, inflation trending to around the 2% target and 4% unemployment. It's not clear to us that the Fed will be forced to cut interest rates materially if you get that kind of perfect scenario. So that's our kind of forecast for 2024. Lots of risks remain. We can talk about those a little bit more as we go through the program. So that's our quick scenario. Greg, back to you.
Thanks, Ken. Next, I'd like to introduce Daniel O'Keefe, the Commissioner of the Department of Economic and Community Development. Welcome, Dan.
Thanks so much. So I think Ken described his outlook for the overall economy as cautiously optimistic. I would describe my outlook for the Connecticut economy as overtly optimistic. And not because I realize that can come across as cheerleading or arm waving but so it's not that. It's actually based on what I'm seeing in the data. So let me give my background briefly, and then it'll help inform the lens with which I'm coming at this. So my background is in and around investing. I spent the last 25 years investing in technology companies, growth technology companies. So these were companies typically growing 20% or more. And if you think about the nature of that work, it's, analytically analyzing a market and a company and looking to invest in those where you believe the prospects are brighter in the future. As I considered taking on this role, and the role I've taken on is first as Chief Innovation Officer for the state of Connecticut. I took on that role in July of last year. And then Governor Lamont asked me to expand that portfolio to include economic and community development. So I now serve as Commissioner Designate of the DECD until confirmed by the General Assembly, which will be sometime in February or March. And as I looked at the Connecticut economy, what I saw was, a period of real challenge coming out of the Great Recession. So the period of 2008 to 2018, our economy contracted on an inflation-adjusted basis. And I'm no economic genius, but contraction is not what you're looking for. By the way, only 3 states can say that. Since then, coming out of the pandemic, we've seen a pretty dramatic change in trend lines. So in 2020, the year of the pandemic, we were the 47th worst performing state in the country. Then we were the 33rd. 2022, the latest year in which we have data from the BEA, we were 7th in the country. And the last time we were 7th, last time we were in the top 10 was 2004. So just kind of gives you a sense for the acceleration in economic growth we've seen. And we've also seen an acceleration and a growth in our population. So in the last 2 years, this is Census Bureau data, we've seen tens of thousands of new residents. We've analyzed it. These tend to be, younger families looking to move here to raise and educate their children. And as I kind of look back on some of the reasons why I think we're seeing some of this, none of us wanted a pandemic. But I do have a thesis that the pandemic rewrote certain economic rules in a way that is benefiting and that I believe can continue to benefit a state like Connecticut. And the thesis is relatively simple. If the geographic bond between employer and employee is evolving, and by the way, I assume everyone on this webinar is an employer, so I'm not suggesting it goes away. I think culture matters. Having folks together in person matters. But I also don't believe the structured 5-day work week is coming back for many industries. Some industries it's required, in person is required, but in many industries, I do believe something less ends up being the steady state, whether that's 3-4 days, who knows. And if that's the case, it means individuals can increasingly choose where to live based more on quality of life than necessarily a commute to a concrete and glass box someplace. And if that ends up being true, that has really interesting implications for a state like Connecticut, where our education system is high quality, where it's an incredible healthcare system, so a great place to take care of yourself, your aging parents, and a great quality of life. Now, none of those things are inexpensive. So, I acknowledge and recognize that it's going to require continued investment to support some of those points of comparative advantage. But I do think they can sustain. I do think in this post-pandemic world, some of these elements that perhaps in the past seemed soft and fluffy now are actually critical to maintain because it's the reason why people are voting with their feet and their wallets to come to Connecticut. So I'm particularly excited to take on this mandate at this particular point in time. I think this is an inflection point in our shared history. And I can say we've got an administration that is deeply aligned towards supporting these continued trend lines. I'll close with one last piece, which is everything I've just described is ways to grow and invest in our future. But you can't build a house without a solid foundation. So the other element I do want to acknowledge is the work that's been done over the last 5 years to really put our fiscal house in order. Over the last 5 years, we've had consistent budget surpluses. We've paid down almost $8 billion in our unfunded pension liabilities. We've maxed out our rainy day fund at a statutory cap of $3.3 billion. All of these are important elements to pay down the mistakes of our past, to put our fiscal house in order. And now everything I described are areas in which I see our ability to invest in the future. With that, I can close and hand it back to you, Greg.
Thanks, Dan. Great insights. Last but not least, Johanna Bond, President of the Middlesex Chamber of Commerce. Welcome, Johanna.
Hello, Greg, and thank you very much for inviting me to be part of this panel. Here in Middlesex County, we closed out 23 with many exciting economic development projects across our entire region, which was great to see. Our new small business startups are really strong. We see a lot of companies continue to expand. Businesses are really looking to make significant investments into capital and infrastructure improvements in order to grow. And speaking with my small businesses and businesses throughout the county, really 24, their focus is innovation and collaboration. Some of these are clean and green technology. A lot are looking at AI opportunities. And in the manufacturing world, vertical integration is the big topic right now. As spoken about before with the pandemic, we certainly, learned so much and made a lot of positive changes because we had to during the pandemic, but there's still a lot that we need to do. As addressed before, there have been a lot of changes to employees' expectations regarding remote work, and businesses are constantly competing for talent. Similar to what you found in your survey, a significant concern of Middlesex County businesses is hiring and retention. To address this, I think we all need to get together to educate our employees through training and upskilling, develop interest and training opportunities for trades, and truly provide incentives as childcare and transportation. But the biggest issue is housing. Workforce housing and affordability must be a priority that we all take on. I myself personally have 2 grown children. I have a nurse and a state trooper who are both working full time. They love Connecticut. They want to stay in Connecticut, but they're really questioning the affordability because it's very expensive. So we really need to address this housing issue. Connecticut is an amazing state. We all know that. We love to live, work, and play here. That's why we're here. We have a fantastic educational system and are rich in diversity, culture, and experiences. Truly, we have it all here. But in order for our businesses to grow and prosper in 24, we truly all need to roll up our sleeves and get ready to put in the hard work alongside our great governor and the legislative leadership to continue making Connecticut affordable and truly competitive. So I look forward to your questions. Thank you.
All right. Thank you, everybody, for your insights. Now we're going to jump into the panel discussion. So I'll invite all of our panelists to put on your video monitors and turn up your volume. A lot of good insights from the intros. Dan, I want to start with you. You're talking about sort of the potential advantages that new workplace flexibility offers to Connecticut. So how does Connecticut sort of leverage that? What investments need to be made? What investments have been made? And what other investments does the state need to make to leverage that workplace flexibility that might make Connecticut more attractive?
Yeah, no, it's a great question. And look, John, I think mentioned a lot of the characteristics that exist here already around quality of life. But I think now is a point at which it makes logical sense to double down given the trends I described. So let me comment on a few. Part of what attracts people to the state of Connecticut is its economy. So I mentioned the increase in growth that we've seen. Our economy is a little overexposed towards certain segments. So finance and insurance is 14% of our GDP. Manufacturing, which for us is principally the defense sector, is about 12% of our GDP. And one of the challenges, those are great industries for us, but they go the way of externality. So finance and insurance goes the way of capital markets. The defense industry goes the way of global unrest. So those are externalities we can't necessarily control. It's outside of our control. But what we're seeing is an influx of industries that are in growth areas. This is things like insurance becoming insurtech, financial services becoming fintech. And I mentioned the influx of the population that we've seen over the last 2 years. I travel around the state and I have conversations with many of these folks, and they do tend to be in some of those newer, more growth industries. We're seeing a lot of entrepreneurs. We're seeing a lot of startups. We're seeing a lot of tech companies come into the state. And I think it is that flexibility that allows for that, because particularly in some of those more emergent industries, these more startup companies, this concept of flexibility or being entirely hybrid, entirely virtual, it is a little more commonplace. So I think part of what's attracting people is the economic profile, and again, the reacceleration we've seen in that economy. But the second piece is really about our communities. And I think this is a really important point, because if I'm right, and individuals can increasingly make decisions on where to live based on their own decisions and not necessarily a calculation of some commute. What that means is the marketability of some of those more personal attributes, a great place to raise a family, become increasingly important. And so I think investing in our community, investing in our cities, and supporting some of the transformation that we're seeing there, I think is a critical set of programs that we have available. I'll mention a couple if I could do my own commercial. So we have a brownfields program, which is looking at helping take former industrial sites industrial sites where the profit motive is not enough to incentivize remediation. And we're helping to support the conversion of those sites into new use cases. We have the Community Investment Fund and our capital projects funds that are going towards taking oftentimes older buildings or older neighborhoods and helping to incentivize and support their transition into best-in-class mixed-use housing and development. And I want to make a comment here about our cities. You know, one of the comments I'll often get is, you know, lamenting that we don't necessarily have a big city like a New York or a Boston. And look, I'm over it. You know, I don't think our future was ever big cities. You know, I think big cities still have value. I mean, I think New York is always going to be New York. And if you're a 22-year-old looking to meet your future spouse, then God bless. I say that kiddingly. I met my wife in a bar when I was 22 in New York. But I think, you know, what is our future was always our present. It just matters now post-pandemic. It's smaller, more livable, more walkable cities. You know, that's what people are looking for. People who want to live in an urban environment aren't necessarily looking to live around, you know, traffic and noise and glass and steel. You know, they're looking to live in neighborhoods like you see in Stamford and New Haven and elsewhere, which are super comfortable for a family to live in and yet have all the amenities of an urban environment, a city environment. So I think that's what we're looking to continue to support and promote. You know, we want to continue to promote the trend lines we're seeing around this influx of new talent and energy, these trend lines we're seeing around economic acceleration, not only from our existing industries, but from our new industries, and then reimagining some of our communities, you know, in a way that people really find, you know, quite attractive.
And Dan, when you mentioned you're seeing startups move to Connecticut, are they establishing satellite offices, headquarters, or are these just going to be remote operations that the CEO just happens to move here?
Let me challenge something. Someone define to me what headquarters means. And I say that, look, I always have to be careful here because I don't want any company on the planet to think their headquarters is not welcome here. We have programs associated with incentivizing headquarters moving here. We have programs associated with keeping headquarters here. They matter and they'll always matter. But if the post-pandemic trend lines I described tend to end up sustaining, then the concept of a headquarters is what you just said. It's often where the office of the CEO happens to sit, which doesn't have the same organizing principle around all of its employees they once did. You know, you can move the office of the CEO to or from one place. It doesn't mean anymore that every employee needs to go with it. And so that's why I come back to this concept of if these decisions are federating, then we need to do a better job of marketing all that is great about the state of Connecticut. You know, that's what's going to continue to attract people here. People are voting with their feet in their wallets because they're seeing it. They're doing the work for us. I want to continue to get the message out there to make sure everyone understands, you know, what's happening in Connecticut and how different it is than what I've seen in the past. You know, I get a lot of skepticism when I travel the state. And the skepticism I get is not from new residents. It's from folks that have been here for a long time. And by the way, I've been here for a long time. I get the skepticism. I know why it exists. But skepticism is itself an economic toxin. You know, if you don't believe the future is going to be brighter, you don't hire that person, you don't start that business, you don't buy that piece of equipment. And I'm a skeptic by nature. If I were looking at trend lines and seeing something negative, I would shout the skepticism from the rooftops, but I'm not seeing that. And I don't want our own skepticism to be the reason we squander this particular moment. And that's what I'm trying to make sure people understand is this is just what the data is suggesting. And now I think is the time to just get going.
Sure. Ken, a couple questions based on your intro. You said, you know, consumer spending has held up. You know, first, why has consumer spending in your mind held up? And you talked about, you know, rates and questions about how far rates will drop in the first quarter or during the March meeting. What is your sense of overall this year on how rates will go throughout the year?
Yeah, so I think it goes back to why didn't we even have a recession, right? And I think part of that is the typical economic playbook is when the Federal Reserve raises interest rates, and they did that in the fastest way in history over the course of the last 2 years. when you raise interest rates, they typically go too far. That slows the economy. People start getting laid off, and you have this kind of death spiral. I think what's very different this time is that interest rates went to zero during COVID. And so anybody who had a mortgage or corporations that had debt had ample time to refinance, and the vast majority of people did. And therefore, I think the economy today is far less sensitive to that normal Fed interest rate hike cycle, that typical raise rates force the recession. And so the economy is demonstrated to be a little bit more resilient. In addition to that, refinancing and lowering the level of debt, as Dan was just saying, Connecticut paid off a boatload of debt, and so did individuals and so did companies. So they're less leveraged, and so the sensitivity to interest rates is perhaps not as great as it was in previous recessions. Also, we're a far more service-oriented economy as opposed to a manufacturing, so we're not as heavily indebted as we were. So I think that helps explain why interest rates, as fast as they went up, didn't have the kind of textbook response. In addition to that, there was an enormous amount of money that was put out into the economy, both on the corporate side in the form of PPP loans, and then on the individual side in forms of all kinds of COVID-related support systems. And so the combination of that money built up excess savings, and the consumer has been pretty actively spending it down. They haven't quite got there yet. I think somewhere in the middle of 2024 is when that excess savings is going to be exhausted. But that's provided a pretty big fuel for the consumer spending that we've seen over the course of the last year. And that's one of the reasons why I'm a little bit more cautious about the economy, particularly as we go into the second half of the year, is if that excess savings starts to diminish, does that slow consumer spending and slow overall economic activity? So that's kind of one of the sources of our caution. That being said, we have seen some cracks in the consumer in terms of credit card balances, credit card defaults, loan payment type things, but they are going up from historically low levels. And they've gone up, yes, but they've gone up to areas that are still considerably below where they would have been in any kind of economic recession. So we'll watch that, but I don't think that is a source of major concern. So cautiously optimistic, but we're going to watch that consumer, because consumer spending is roughly 2/3 of the economy, and we need to keep that up. And as long as the labor market stays as resilient as it is, but my guess is it's going to stay pretty strong, perhaps not as strong as it was in 2023, because that excess savings is being diminished.
Sure. Have higher interest rates had a bigger impact on business investment than it has on consumer spending? What are your thoughts there?
Well, when you look at the GDP for the third quarter, we haven't got fourth quarter data yet, but what is very interesting is kind of and you can kind of see it in the survey results, where businesses are, again, cautiously optimistic. 43% of your survey says things are going to improve significantly or slightly. So that's a pretty good number, and it's certainly up from the recession expectations of last year. But what's very interesting is, while they're saying they're very optimistic, business fixed investment in the third quarter was effectively zero. And I don't know whether that is a hangover from COVID, where there's just so much uncertainty and doubt as to whether the economy can remain as resilient as it is. So the question is, did higher interest rates spook off further business investment? That's a possibility. Or is it just that the businesses are still a little bit cautious because there is a lot of noise in the system. We have a political election this year, regardless of which I think it's fair to say it will be contentious. So you have all the noise associated with that, and that starts in earnest next week. We have a COVID virus spike that's concerning. We have labor force issues, commodity supply issues. So there's a lot of things to continue to worry about. They haven't gone away. But I would submit to you that the rise in interest rates, as dramatic and fast as it's been, I don't know that it's had that major impact on the economy, at least not yet.
Sure. Thanks, Ken. Johanna, you mentioned workforce issues are a huge thing impacting your members. What are your thoughts on how sort of Connecticut, and it's a national issue as well, how we come this issue and get more workers in the pipeline and get employers to find more workers? What are you seeing from your members?
Well, honestly, obviously it's a significant concern in Middlesex County, and it affects all sectors and all size businesses. What we need to do is we need to sit down together, right? There's a ton of opportunity there to work with our local higher education. You see a lot going on with our local high schools and manufacturers getting together, but I think it's about partnerships. I think the word for 2024 is partnerships and learning how we can collaborate together to do this. I think it's very easily identifiable what's needed. We just have to work together to do so. I will say that there is a lot, we work very closely with our Workforce Alliance and our Workforce Incentive Boards, plus Office of Workforce Competitiveness, but that's where it needs to be true public-private partnerships that sit down together to address these needs. I think we are working very closely with our manufacturers throughout Middlesex County and beyond to address this. One of the key things is putting the stakeholders at the table to find out what their needs are. So putting them at the table, having all these leadership kind of address what we're going to do and identify those needs, and us being the people who try to help them get those needs in training. It's crucial that everybody sits around the table and has skin in the game in this. So I think that's the best thing moving forward is truly partnerships.
Sure. Dan and Ken, do you want to weigh in on the workforce shortages and sort of how Connecticut and the rest of the country sort of sees its way through the issue?
Yeah, I'm happy to. And
go ahead, Dan.
One thing I've learned in my grand total of 6 months of public service is that these are complex systems. There certainly isn't a magic bullet, and there isn't necessarily one or a simple number of inputs that one can adjust and see an outcome quickly. So this is going to take applied leadership and sustained effort. That being said, if you look at our job vacancy rate, it is lower than the U.S. overall. I don't mean that to suggest that we don't have an issue we have to work on. What I mean is it's not unique to Connecticut, and we're all working on this challenge. We do have more labor demand than labor supply. That's better than the opposite, so I'll take it. And if you look at our job vacancies, we've had this sort of sustained 90 to 100K in terms of a gap that we're working on whittling down. We have a couple strategies against it. The first is, someone said to me, you can't manufacture people. It's sort of not true. You can manufacture people. You just gotta train them and you gotta import them. You gotta train the workforce of our future. And that's one thing we're doing. One of our biggest gaps, by the way, is in nursing, skilled nursing. And we recently announced a new nursing school at UConn that we're doing with a very generous philanthropic leader. And we'll continue to do that. So we'll continue to invest in our higher ed to make sure that we are training our existing citizenry for the jobs of the future. And then the second thing is you do everything I was describing, which is you continue to make Connecticut a place where others want to come from other states and internationally to come and work. That's how you actually manufacture people, is you attract them to the state. And that's what we're doing. Now, again, this is going to take some time. We talked about just some of the things coming out of the pandemic. Not all of them were good. One of them was an incredible amount of capital creation, which Ken described. And, it's impossible not to have inflation when you have that kind of capital creation. It's the crowding out effect. And it's very difficult to sustain, kind of supply chains of both people and goods when you have those kinds of massive shocks in demand. But we are now getting to a place now where we're starting to see more sustained growth lines. And I just think we'll just continue to do the good work that we're doing.
And so I agree with both Johanna and Dan. It is a national concern. I think when we look back at COVID, there were three major sources of that labor contraction. One, and I think this has already begun to reverse out. As I mentioned earlier, a lot of that excess savings has been diminished, and for young workers during COVID, and this may be a course, but we were effectively paying them not to go to work. Those programs are extinct. They've gone by, and the excess savings that they may have created with those programs is being diminished. So we're starting to see younger people re-enter the workforce, which is a very good sign. Secondly, during COVID, like everything else, the government also had a pretty big shutdown, and the processing of legal immigration. So I want to make a distinction between the southern border and illegal immigration. And I'm talking about legal immigration. The number of immigrants processed by the federal government dropped materially during COVID, and it's just now getting back to pre-COVID levels. And it was down over 1 million per year. So, and that's important on both ends of the economic spectrum, because immigrants, on one hand, tend to fill our lower income, entry level, low skill positions. So you think about hospitality and services, things like that. But it's also on the high end where, to Dan's point earlier, you have a huge defense business. They are in desperate need of high-end skilled engineering and computer science skills. And quite frankly, the U.S. just doesn't produce enough of them domestically. So we have to have immigration on that high-end, high-skilled tech level. And the good news is the immigration is starting to improve substantially. So there's room for optimism there. And then thirdly, and this is, I'd offer this as an opportunity for Dan, is in COVID, we saw what economists call retirement above trend, a bunch of people who were turning 55 and they ran for the exits rather than deal with all the headaches that COVID brought in the shutdown. And we're, obviously the baby boom generation is starting to enter that retirement phase in earnest. You have a gigantic intellectual capability in these retired people. And, to kind of echo Dan's thoughts, if people are looking to get out of the big bad city or the close suburbs and move to more hospitable places, the retiree community, maybe they don't come back full time, but they're an enormous source of really high-end talent and knowledge that is probably willing to move out of that big city and downsize from that big suburban house in a major city like Boston and New York. And suddenly a nice cozy place in Connecticut looks really attractive, and they might be able to go back to work a little bit. I think one of the things that has surprised us is that we, as economists, expected the retirees to re-enter the workforce, and they just haven't to the levels that people thought. And I think that's an opportunity for people with a huge talent base and knowledge base to attract some pretty interesting employees. So I think on three fronts: the younger people coming back, largely because they have to, they're not being supported to not work. Two, the immigration system kind of righting itself after the COVID situation, and then trying to attract some retirees back into the workforce. I think those are three promising trends that should help with the labor supply situation.
Sure, and I know affordable housing has obviously been linked to the workforce shortage issues. It's been a big issue in Connecticut. The business community has gotten behind efforts to grow affordable housing. And questions open up any on the panel. So how does Connecticut grow its affordable housing stock? I know there have been some efforts at the state level, but what are thoughts on how we sort of improve that housing stock to get more people to move here and be able to stay here?
So I'd be happy to comment on some of what the state is doing. And I should say, I have a fellow commissioner who leads our Department of Housing, and this is really her area of expertise. But we partner closely together around this, and oftentimes the capital projects I mentioned within the DECD will collaborate with the Department of Housing. First, let me just comment on the concept of workforce housing, because as you've all probably seen, there does tend to be a fair amount of resistance to it in some of our communities. And it's resistance, I think, at times because there's like this perception that workforce housing is like, I don't know, I was a fan of The Wire. If any of you watched that, like the sort of the slums of Baltimore, that's going to be like this row house looking thing that's going to be a blight on the community and bring in people that, are problematic. That is not what workforce housing is. Workforce housing done right that's for our teachers. That's for my mother was a teacher. That's for our policemen, our firemen and fire people, our police people. It is for our communities and those that are supporting those communities. And when done right, it looks incredible. It is in a modern sense. These are things that augment communities. And I think we just need to really kind of get that message out as constituents, as taxpayers, that this is important to us, and make sure our local leadership understand that this is a real constraint on our economy, which hurts all of us. Without housing and without affordable housing, our economy can't grow at its potential. And so I think we need to address it. If you look at our programs, we'll be putting in, I believe it's not my agency, so forgive me. I believe it's $800 million over the next few years, to support some of these development efforts. And so we are all in around it, but we do need local support. These tend to be local zoning ordinances, local developers, local political leaders that need to be partners in this effort.
If I can jump in real quick, totally agree with everything you're saying, but it turns around to a conversation. Obviously a lot of the communities within Middlesex County are smaller, right? So it's exactly that. You say what was affordable housing, which is now workforce housing. That's what you hear. You hear, oh, not in my backyard. And that's not what it is, and I am a huge proponent to say, no, it's about the people who are working, teaching your children. It's the police officers, it's the nurses, it's the people in the community. So, I think we have to change the conversation and we have to control the conversation and the narrative so that people truly understand what that means, first off. Second off, I think we have to change regulation. A lot of these, people like we have developers who are more than willing to get out there and develop, right? But, they don't have infrastructure within the community. Also, there's this whole thing with, how many gallons per minute for a septic tank that can run. It really holds a developer's hands at trying to do anything. So, to have a conversation around with the legislature around legislative changes so that, towns have the abilities to, change their regulations a little bit, that developers can come in and it's easier for them to do that work. I think that has to be part of the conversation as well.
Joanne, are you seeing a lot of apartment developments, in Middlesex County? I know there's been a lot of different proposals around the state over the last few years. Higher interest rates, I think, have slowed down some projects. But what are you seeing with a new apartment development? And then also, what are the other growth areas you're seeing in Middlesex County?
Sure. Actually, it's funny you mentioned the apartments. So by the end of 2025, we do expect to have over 1,000 apartments in and around Middletown. Portland has 300 coming on. Cromwell has another 200, and these are multi-use properties, right? So they're walkable. They're going to be that amazing kind of environment that we're looking for. Middletown will have about 600 coming online. So we do see that, there is a lot of development with that, and they are under construction. So it's been fantastic to actually watch these buildings erect, right? Down in our lower River Valley, we've had two amazing units that were built with about 70 in one and 90 in another. They're completely full. They were filled before they were even ready to open. So, it shows the need and desire for apartments, not everybody wants to own a home and have to snow blow like we did the other day, right? So that's just the reality. So I do see that happening. As far as growth, I think that it really boils down to, Middlesex County is an incubator. We have so many solo entrepreneurs in our area. And I think that that's a really great industry to look at because there's so many people out there that are just ready to burst. They just need the guidance to do so. So one of the programs that we have here at the Chamber is Muse Plus. It really is an incubator program to help these people with mentors and business leaders that can help them kind of get off the ground and flourish, and then obviously get involved in the Chamber to really expand. But I see that as a growth area in our region, it's definitely the small entrepreneur right now.
Sure. Ken, I want to talk a little bit about supply chain issues. We haven't heard as much issues around supply chain. Talk about where we are with those supply chain issues that came up during the pandemic, and how have they sort of changed the way companies think about their supply chain, and how sort of manufacturers have invested in their supply chain, and has it led to reshoring, or will it lead to reshoring?
Yeah, so I think the bulk of the supply chain constraints are beyond us. So, last year we were talking about 100 and plus ships being anchored off the coast of the port of Los Angeles and Long Beach, waiting to get into port because things were all bottled up. But those are largely behind us. Commodity prices have come down. And I think the supply chains, while there are pockets that still exist, for the most part, are far less problematic than they were. One of the reasons why I'm a little bit cautious about my inflation outlook, particularly as we move into a green economy, is the supply of a lot of the commodities that are required to move that green movement forward are in short supply. A lot of them don't come from very friendly places, and there's a lot of NIMBYism when it comes to building new capacity, and so there is a fairly dramatic shortage of industrial and particularly environmental commodities, and in the short run, I don't know that it's a major problem, but in the long run, it gives me concern, and I do think we've kind of gotten a free pass on commodity supplies because the prices have come down, but it's come down largely due to oil prices. It's such a big, heavy weight in the commodity indices. And that, quite frankly, is due to just the remarkable technology of fracking, and that the ability to just generate oil and natural gas is just as great as it's ever been. So despite great incentives to move away from fossil fuels, the supply of fossil fuels because of the new technologies is great. Has it led to reshoring? I think it is. China has created kind of a hostile environment, and obviously the COVID crisis created a huge supply chain that business owners have to react to. But on an ongoing basis, the question. So I do think a lot of people are reevaluating their dependency on China. That has been the case, and I think it will continue to be the case. Whether that results in new manufacturing capabilities in Connecticut or not remains to be seen, because I don't know if it's just reshoring. It might be exiting China and diversifying your supply chain, but that could mean you're moving your manufacturing or to China or to Indonesia or to a booming economy that is India today. But nonetheless, I do think the reshoring is there. It's another reason why I'm a little concerned about inflation longer run, because bringing that capability back to the United States, while it may help with supply chains, it will be more expensive here, and that's going to be inflationary over time. It may be counterbalanced by other benefits, but clearly the reshoring or the exiting of China and the reshoring is happening, and hopefully that will alleviate kind of the major supply disruptions that existed during COVID.
Sure. Dan, any thoughts on supply chain and its potential impact on manufacturing? And what is your sense of defense and manufacturing, obviously a key industry in Connecticut? It's seen some growth in recent years, largely driven by some of the bigger contracts from Electric Boat, Pratt & Whitney, Sikorsky. What's your outlook for advanced manufacturing in Connecticut?
Yeah, I might be a little more emphatic than just a little bit of growth. It grew pretty significantly in 22. Now, look, I mentioned the defense sector can go the way of externalities, one, which are hard to predict, and two, aren't necessarily what we're looking for, right? It's driven by global unrest. But if you look at the manufacturing sector in the state of Connecticut, again, most of which is the defense world, that grew to be as big as 17% of our GDP, and that was the buildup coming out of 9/11, and then it declined to as little as 10% at one point, and that was a big contributor to what we now refer to as our lost decade. It was a lot of it was that sector contracting. If I now look at it since then, it's now grown to be 12% of our GDP and grew, and I hope I have this number right, I think it was 5% in 22. Again, we don't have 23's number yet, so it grew pretty significantly. When 12% of your GDP that had been declining and then had gone flat grows at that kind of a rate, it's a real a headwind becomes a real economic tailwind. And if I look at the trends around, what does get near shored, it tends to be, suppliers to defense companies want to be close to those defense companies, both for iteration and R&D, but also because these tend to be, highly sensitive, devices, components, et cetera, that are going into quite sensitive, complex, larger machinery, things like a nuclear submarine. So the defense sector, I do think having, a pretty meaningful defense sector in the state of Connecticut is uniquely benefiting from some of these nearshoring trends. And I'm not just describing the large companies as you did. I'm also talking about, the thousands of companies in the state of Connecticut that support those larger companies. I do think it tends to be a positive thing for us.
Sure, and everybody's talked a little bit about office space downsizing. The city of Hartford is very dependent on an office population. Open this question up to anybody, but what do cities like Hartford do with the significant office space vacancies that occur? I think Hartford's projecting to reach 37% vacancy by the end of this year, which is a stunning number. But what can be done to what can be done with this empty office space in Hartford and other cities like it?
Happy to jump in there. I just don't want to dominate the conversation, but I think that probably has to fall on me. So, I talk about Hartford specifically, but about our cities generally. I referenced it before, which is not only do I not think our future is necessarily large cities in nature, I also think it is solely or principally commercial use case in nature. As we reinvent our cities to be more livable, more walkable, smaller, greener. One of the things that I think is going to happen, and it's going to take time, is the conversion of principal commercial use case plant into mixed use. Now, I spent time with the former mayor of Hartford. We've talked about some of the buildings for which this is plausible. It isn't every building. Some buildings were just simply built in a way that cannot be converted without having to really reconstruct, and oftentimes it doesn't make sense. But I do think as you start to see, more of the population of Hartford come back, and by the way, one of them is state employment. Right now, per union rules, state employees are only in 1 day a week. I would like to see that. This is going to be a negotiation with our union, but I would like to see that be in the office more frequently, because I think we serve our constituents better when we're in the office working together. Now, in that case, and in every case, I don't necessarily see it going back to 5 days a week, but something more meaningful, and that will support more of the energy within Hartford. And I think we just have to move away from this compartmentalization, that I described before, where the 5-day structured work week supported compartmentalization of energy, such that energy in the urban core during the work day shifted to the suburbs and the exurbs on nights and weekends. I think now with the deconstructing of the 5-day structured work week, that just makes everything feel less energetic. And so I do think this concept of converting and becoming more mixed use, I think, is critical. We've seen it in Stamford, we've seen it in New Haven, and I think we'll see it increasingly so in Hartford.
Ken, sort of a related question. There's a lot of reporting. We've done a little bit of reporting in 2023 about commercial real estate and the potential threat that it has on the economy. Is there any real potential threat from commercial real estate, loans and debt having an impact on the economy in your mind in 2024 or a year?
So I think we need to be a little careful when we talk about commercial real estate, because I think everybody's mind goes, just like your previous question, goes to office, but commercial real estate is much bigger than that. It's warehousing. So if you look at warehousing and you think about the amount of e-commerce that has performed remarkably well. Our discussion earlier about multifamily housing, Johanna was talking about all the units coming on. There is some relief coming in terms of multifamily housing, because those low interest rates that we really experienced going back to the great financial crisis in 08-09, interest rates were extremely low really for the last 12 years. That resulted in an enormous amount of development. And so when you look at industrial space, you look at data warehousing, you look at multifamily housing, that part of commercial real estate is quite frankly pretty healthy. it really is the office space in major cities that are problematic. And even then, if you have a Class A building that's relatively new, those buildings are in pretty good shape from a vacancy standpoint. The real issue is when you go into the lower quality, older buildings on the outskirts of the city. That's where I think things become really problematic. And quite frankly, because the buildings are older, the idea that it's very flippant to just say, well, we'll just make apartments and condos out of it. That's really challenging when you look at some old office space where the center core of every floor is pretty far away from a window, and most people don't want an apartment that doesn't have any windows. So it's easier said than done to say, oh, we're just going to take all these office towers and convert them into apartments. But I think in terms of an overall threat to the economy, there's no doubt that there are commercial real estate office buildings that will probably go bankrupt and default in the near future. But I think it's a far smaller subset than what meets the eye. And generally speaking, when you talk about a place like Connecticut, where you're not talking about a major city like Boston or New York or LA or Atlanta, those office buildings tend not to be as expensive, and they are generally funded by larger banks, so that those banks typically have a little bit more wherewithal to handle any kind of non-performance on loans. So I'll keep my fingers crossed a little bit, but I think the pending doom surrounding commercial real estate, I think, is a little overwrought. It's clearly office in major cities is problematic. It's too cavalier to just say make them all condos and it will all go away. So I think it will be a problem, but I do not think it will rise to the level where it's going to prove catastrophic to the overall economy and force us into recession.
Sure, we have just a few minutes. We have just a few minutes left. Johanna, we're approaching the legislative session in a few weeks, and I know chambers always keep an eye on the session. You mentioned housing and regulatory reforms. Any other things that your chamber is going to be looking at as we approach the session next month?
Yeah, absolutely. We actually just approved our legislative agenda yesterday at our executive meeting, so it's perfect time that you asked me this question. Obviously, one of the key things is working on, housing, right? We've got an affordable housing committee here at the chamber, but it's regulation. So we've got to keep our eye on that game. Another one is truly to support the association health plan legislation to lower the costs and provide better benefits to employees. That's something that came out last year. It was kind of put on pause. So, it's something that we're really going to be working on to focus on this year. Another thing that's a big focus is truly partner with the business community to support education and training programs and streamline the certification process and the requirements to attract and develop talent. It's amazing when you look at the fluctuation of how much somebody has to pay for certification. If we could just streamline that, that would be fantastic. We've got it, like I said, we have a very robust legislative committee here. We work very closely with CBIA and other organizations to make sure that we're all on the same page. But, it's working hand in hand. I have to say, we have an outstanding working relationship with our elected officials, and the state's done a great, great job at maintaining the fiscal guardrails. That's a huge thing that we've done, and we've done it well. So, our goal is to make sure that, we look at regulation, we try to ease up some things, and truly just keep the state on the same path. Keep it on a great path. I think they've done a great job in the legislature, and it's having conversations and communicate. So I look forward to what this session has to bring. You're on mute, Greg.
Dan, any thoughts on what the legislator, what DCD will be looking for the legislator or the Lamont administration in terms of economic development programs?
My successful confirmation. I'm kidding.
Is that happening in February? Is that
I'm
Great
totally
answer,
kidding.
by the way.
Thank you.
Great answer.
I'm totally kidding. It's they've committed to me early in the session, but I don't have a date yet. So no, I would say, Johanna mentioned the fiscal guardrails, which I am fundamentally supportive of, as a constituent. And if you look at the sort of the past 5 years, what they have done is twofold. It put our fiscal house back in order. So paying down our debt has allowed, all four credit rating agencies have increased our ratings. That's when that process started. It was the first time in 20 years they had done that. But it also did a second important thing, is it sent a message to the investment community. And by investment community, I'm defining this very broadly. I mean that person thinking about making a hire or buying a piece of equipment or starting a business, anyone thinking about investing in something can say to themselves that chaos we saw during the lost decade, which would this sort of boom and bust cycle, because our economy is so subject or exposed to capital markets externalities, is gone. That's what that did, is it gave confidence and confidence and stability. And if you look at where we are right now, we are in a tight and tightening cycle. I don't think that's news for anyone. Never bet against the Fed. We have seen that start to tighten. And so, but there will be another upcycle. If one thing I know from now having lived through 3 of these major cycles is there's always going to be another cycle. And really what I want to do is spend a lot of time, and I'm already doing this with members of our legislature, just talking about, when we do start to see that next upcycle, some of the more meaningful, transformational, investments in our future we'd like to consider. So I think that's really my goal. I'm new to many members of the legislature. I want to make sure they know and understand that I am eyes wide open and a realist. But I also am seeing these trend lines I want to invest against, because I do think the future is brighter than our present, even though I think the present is bright. And I just want to make sure we're front footed on some of those. So those are conversations we're already having, and really getting people's minds wrapped around what this next 10, 25 years can look like.
Sure. Thanks, Dan. And we've reached the end of our time today. I'd like to thank each of our panelists again, Ken, Dan, and Johanna, for taking the time to give their insights about the year ahead. And also I'd like to thank our presenting sponsor, NBT Bank, and thanks to all of our audience who tuned in today. Good luck in 2024.
Thanks, everyone.
Thank you.
All right. Thank you, everybody.
Thank
Bye
you.
now.